Good afternoon. I'm not sure I can add anything to basically what I said yesterday on gold. I said that the market did look weak. We actually did come quite a bit lower. We come to 1869. We're trading at 1872 at the moment, so there is a little bit more I think we can go to. Obviously, if we take out the 1869 area, gold will trade quite a bit lower. You will be looking at it coming down to a minimum, I think, of this support here. And we've got that coming in at 1848 twice and 1852. So around the 1852 to 48 area, I think would be the aim for gold. I also think that this 38.2 fib here is coming in at 1838, so you've got to be aware that the market could quite easily bounce back from those lower levels. And that isn't to say it will. I'm just going on what I spoke about yesterday with the triangle, the asymmetrical triangle targeted area, the many points that we added on, where we added the points from, the characteristics of gold, where you can see where it's double topped up here. This continuation pattern follows through really by this continuation pattern. So gold has been a bit in the doldrums, I think, since going back to when we started to fall back in August. So we've seen quite a lot of sideways action in the market, but I think that is going to change now, because I do think gold has not a longer term direction, but it certainly seems to me that it's got a shorter term direction, with the fact that, you know, we have this 1742 measure target, but also that 1764 area. And you can see that this is when gold made its break up, when it broke through, as you can see, those May highs. So as soon as it did that, gold really was up and away. So the break point doesn't necessarily mean to say that the uptrend is over. What it means is that it can come back. Markets easily correct back 50%. They sometimes go to 61.8%. I mean, they do correct. But you also have coming into play at this 50% fib, you have that 200-day moving average, and you can see right from going back over this year that we've only spent a very short while below that 200-day moving average. I know it's a long-term moving average, but it just goes to show you that you've got to go back to December 18 to find, or even like the whole of December, that we stayed below that 200-day moving average. So I think that's quite important, and I think that's quite important for the short term. I think it's quite important for the medium term. So my belief is that gold looks a bit under pressure at the moment, but you will see the buyers marching in if we do get down towards that 1764, maybe 1742, but I put my money on more that 1764 level will hold it. Obviously there's a lot of work to do before we can actually make a play for those lower levels. First of all, obviously we have to take out this. Secondly, we have to take out that fib level, and thirdly, we have to not be too oversold to actually be able to do it. We don't want to be in a situation where the market breaks and we have stochastics at 5%, because that means that the market is going to be running out of momentum. It is going to be a little bit under pressure from the buyers. So we'd like to see it sort of down to that 48, bounce a bit, go sideways, whatever it is that gold does, and then take out that 1838. On the top side, what are we looking at? We're looking at the market under these this area here where you've got two intersecting trend lines, and today these are coming in at 1909. Now also up at those higher levels you've got the 21-day moving average, and above there you have the 55-day moving average coming in at 1920. So you know, there is a lot of resistance up there. You've also got the fact that the market did make a double top within a continuation pattern. You can see it quite clearly here. So at the moment I see no reason to rush out and buy gold. I see every reason to sell it below 1865, looking for this area here down to that 1838. Okay, good luck. I will catch you all later on.